Hello, I'm Lawrence Spear from the OECD's Public Affairs and Communications Directorate. I'd like to thank you for tuning in today to the 5th BEPS webcast. The previous 4 webcasts, for those of you who've been following, were about the elements that we've presented up to date this year. We're now going to give you quite an update on where the project is moving from now moving forward. As usual, we'll have the team from the OECD Center for Tax Policy and Administration here. As usual, as is always the case in these webcasts, we want it to be as interactive as possible. So please enter your questions as the webcast goes forward. You can enter them directly into the space provided. You can also send them via email. The address is right there, ctp.beps@oecd.org. If not, please go ahead and send us your tweets, hashtag BEPS. With that, I'm going to turn the floor directly over to Pascal Saint-Amand, the director of the CTPA. Pascal?
Hello to you all. Very happy to be back to you on an update on the BEPS project. It's been 3 months we haven't done this, so we hope that we will be informative to you today before the Christmas and New Year's break, so that you have all the information before leaving for those of you who are leaving. Very quickly, an update of what happened in the G20. You have this just to remind you of the basic. We delivered to the G20 finance ministers and leaders in Brisbane some reports, some instruments, hybrid mismatch arrangements, treaty abuse, transfer pricing intangible paper, and transfer pricing documentation, country-by-country reporting. And the reactions from the G20, you have them in case you didn't notice them earlier, but were very supportive and welcome warmly these. I can tell you, for being in Brisbane, that the leaders of the G20 were extremely happy with this outcome and very supportive. They all spoke highly on this project. But it's time to look forward and to move on. To start with, one immediate follow-up of the Cairns Finance Ministers meeting was about deepening the engagement with developing countries. We have put in place a plan which was reported to the G20 leaders, and this plan now is into force. Very quickly, we can examine it. It's a 3-pillar plan. You can see on the one hand the direct participation of a number of developing countries. You have the names of these countries. It's a nice mixture of low-income, middle-income countries which have expressed strong interest, which do have delegates able to join the working parties and the Committee on Fiscal Affairs, where they will participate to the BEPS work for 2015. And we have already held a meeting with these countries to brief them, to make sure that they will be able to input so that their views be reflected. They will be on a status which is not an associate status, meaning that they would be on an equal footing legally speaking, but in practice their voice will be heard, and we'll make sure that we don't move forward if they do not agree, which makes it even more complicated for the project, but necessary for the views of developing countries to be reflected. We had a meeting last week with these countries. They were very happy, enthused with this work, bringing many points already. The second pillar of this will be to hold policy networks with the regions. We will have 5 of them. We will do meetings on a regular basis, probably twice a year for each of the networks. And here the idea is to involve the regional tax administrations, the participating countries, G20, non-G20, these developing countries which are part of the project, so that the other countries in the region can input in the process and will also use the different global fora that we have to make sure that their views also are reflected in the deliverables of the BEPS action plan. Finally, we are tasked by the G20 to do work with the other international organizations, in particular the IMF, the World Bank, and the UN, to develop toolkits and to develop capacity building instruments, in particular in the area of BEPS. And we have already started working with the international organizations on these deliverables tools, on these toolkits, on these outputs, and we will be reporting on a regular basis with the development working group. And of course, the involvement of the developing countries and the policy networks will be used to make sure that the views of developing countries are properly reflected in all these instruments. But I will now move to the follow-up work of the 2014 deliverables so that the team can explain to you what is being done there, and then we'll move to the 2015 deliverables. We start with the follow-up work of the 2014 deliverables, and I will turn to Rafa, who will drive you through that.
Thank you very much, Pascal, and good day, everyone. So, as many of you will remember, the BEPS project and its action plan were conceived from the outset as a holistic and comprehensive approach to the issue of base erosion and profit shifting. And for this reason, the deliverables that were due and delivered actually in September 2014 remain in draft form, so that the impact on these outputs of the work that is going to be finalized in 2015 can be taken into account, and the approach to base erosion and profit shifting can therefore be set in a comprehensive manner. At the same time, the extremely highly technical nature of some of the items that we deliver in 2014 does require work on implementation and guidance on the application of these rules. And at the moment, work is being carried out in relation to hybrid mismatch arrangements, in relation to treaty abuse, and in relation to the country-by-country reporting template and transfer pricing documentation. And Achim and Marlies will go in more details on that. Finally, further work is also being carried out in the area of the digital economy, following the report that was issued in 2014, which did recommend further work in this area, and in relation to patent boxes and rulings in the context of the work on harmful tax practices. If I turn to the work on the digital economy, this focuses on two areas. First, ensure that the work on the other action items of the BEPS project does take into account and addresses effectively the BEPS issues that are exacerbated by the key features of the digital economy. And this relates in particular to the work on controlled foreign company rules, in relation to the work on the definition of permanent establishment, and in relation to the work on transfer pricing. The other area of work is about advancing the technical analysis of the options to address the broader tax challenges in the area of direct taxation, which primarily relate to nexus, characterization of income, and data. And then once these two streams of work have been completed, it will be possible for the task force to evaluate the outcomes of the BEPS project and the impact that they have on the broader challenges in relation to their scale, but also in relation to their urgency. And this considering also the economic incidence of options that are based on value-added tax or options that are in the area of corporate income taxation, so that a decision can then be taken by the end of 2015 and included in the supplementary report that will have to be issued by then. I'll pause here because I think we have a number of interesting things to tell you today, and turn to Achim Pross in relation to hybrid mismatch arrangements.
Yeah, on hybrid mismatch arrangements, and also welcome to everybody. This is a quick update. It's a recap of where we are. So you may recall from the last webcast, and as Pascal has mentioned, we delivered the hybrids report to the G20. It's been endorsed. In the hybrids report itself, we indicated a couple of items for further work. We call them substantive issues. They relate to the application of the hybrid instruments rule to intra-group regulatory hybrids and certain on-market stock lending and repos. We're working on this. We're also working on the further consideration of the application of imported mismatch rules. And last, we're looking at the question of the CFC inclusion And of course, the question to what extent the CFC inclusion that happens at the level of the shareholder should count for purposes of determining whether the income has been included for purposes of the application of the rule. That's one set of substantive issues that we're looking at. We're also looking at implementation issues, the practical translation of these rules into guidance, and in particular focusing also here on transitional rules of when they kick in and whether we can work on having those coordinated, and we're making good progress on that. The idea here is, as we indicated before, that we plan to have this all wrapped together, so the further guidance on the substantive issues, the implementation question, making it susceptible to administration both by companies but also by tax administrations, have that done and agreed, so that can also be issued in September 2015. We're speaking with a number of tax administrations to make sure that this can be administered from tax administrations. So overall, I think that's a recap. We're making good progress on this, and we're on target for delivery as we had promised in the area of hybrid mismatches. Over to you, Marlies.
Thank you. Thank you, Achim, and welcome to you all. Yes, and the next issue is treaty abuse, Action 6. As you may recall, we came with a report on this, and that report introduced a minimum standard on treaty abuse, and we need to do some follow-up work in relation to that. The minimum standard provides for some flexibility to use a limitation on benefits rule in combination with a principal purpose test or a principal purpose test. And in order to make that work effectively, we need to do some work on the implementation. So that's the first prong of our follow-up work. The second prong is in relation to collective investment funds and non-CIV funds. Also there we had some open ends that we need to take care of and need to look at. And the third prong of our follow-up work is that we need to look at the precise contents of the provisions that are going to be finalized in September 2015, and specifically at the limitation on benefits provision. And in order to get your input on that, we released a public discussion draft on November 21st. The end date for comments is the 9th of January next. And then we will have a public consultation on January 22nd. So you're all invited both to provide comments and also to come to that consultation. And as said, the results of this follow-up work will be presented in September 2015.
And it's back to me. This is an update on where we are under this segment on harmful tax practices, in particular patent boxes, but not just patent boxes, also in the area of transparency. So let me take you through these two highlight points and then give me perhaps a moment to just tell you the other aspects on the work of harmful tax practices, which is of course wider. So certainly one of the focus of interest is the question of substantial activities and IP regimes. And that typically comes under the headline of patent boxes. We are moving forward on the modified nexus approach, where we are making very, very good progress. To recap, the modified nexus approach is something that looks to the substantial activity of the entities seeking to benefit from a reduced tax rate, and is a proportionate approach. And it does say that to the extent the entity itself, its people, engage in the sort of activity of R&D in a similar type that generates the ultimate income, to that extent and in that proportion, that entity should also be allowed to benefit from a reduced rate. And so what we're trying to do here is to have a framework within which we can all agree that benefits can be provided for research and development activities that are also so important for growth as we move forward. So that's the nexus approach on which we say we're making very good progress. Many of you will also have seen the joint proposal that we've welcomed that's been made by Germany and the US. So I think that's the progress here. We recognize that in this space we will need to work on more detailed guidance, translating this then also into the level of guidance that everybody will need, businesses but also, of course, tax administrations to implement that approach. And the point that we made here, and that's what we highlight, it's an EG, so it's not the only one, but tracking and tracing will be important. How do you translate that approach where you need to track expenditure and you need to be able to link it with revenue? How do you do this in the context of a business where some of the IP may actually predate the introduction of the approach? So we need to have pragmatic solutions that allows us to achieve what we're seeking to achieve, but do this at a reasonable cost to business that ultimately will have to implement the approach. So that's it in terms of the update, I think, where we are on substantial activities in IP regimes. The second piece, and certainly an extremely important one, is the question where it's all about rulings here. A key part of the FHTP work has been, of course, the compulsory, spontaneous, you could call it automatic, exchange of information on rulings, a key part of the work we're doing in HTP and BEPS. We need to make sure that these exchanges are broad, but at the same time that they're focused. So we're not swamping tax administrations with a lot of paper, but we have it focused to the issues where tax administrations need to have the information in order to be able to take action. The principles and the framework in general for this, as we say here, are agreed, and we expect the exchanges to commence in 2015. Those are the two types I wanted to give you an update. We should note, of course, that the FHTP work is wider, so we also need to think about the engagement with non-member economies, so going beyond the OECD, going beyond the G20 countries, and what the strategy here is. And of course, the last point that's part of the BEPS action plan also for 2015 is the question of a possible consideration of a possible revision to the factors themselves. So that's, in a nutshell, I think, the status update on where we are in HTP. And I give it back to Marlies, I think.
Thank you very much, Achim. And that brings us to country-by-country reporting and more broadly to transfer pricing documentation. As you may recall, we introduced in September a three-tier approach to transfer pricing documentation, being a local file, a master file, and the country-by-country report. And as you may also recall, the template for the country-by-country report was agreed to by all parties to the BEPS action plan, and said that there needed to be 6 columns that need to be filled out by multinational groups, being profits, the returns, the taxes paid and accrued, the number of employees, and the tangible assets of an M&E group in a certain country. Besides that, what also needs to be given is per country a list of the entities in those countries and also some information about the activities in these countries. So that gives a good overview of the activities of an M&E group worldwide, but also which profits and taxes are attributed in which countries. What was noted in September was that additional work needed to be done on implementation, because to make this a success, the right implementation is key. And therefore, since September, we have been working on these implementation issues. And that work will be relevant to, and for that work is very relevant to also recall that we will have a review of this work in 2020. So we will need to gain experience before that. So if you look at the implementation work, that work will include work, for example, on the timing of the filing of the first country-by-country reports. And in order to look at that timing, it is relevant to recognize this review in 2020 and the fact that we will need to have a couple of years of experience before then. The second thing that it will look at is that it will look at the M&E groups that will be covered by the country-by-country requirements. And at things that we, for example, are looking into are exceptions for small and medium-sized enterprises. The third thing that we will be looking at is the means to ensure considerations that are relevant for the implementation of this transfer pricing documentation approach. The consistency of the approach between countries, the confidentiality of both the global file and the country-by-country report, and, for example, also about the use of the country-by-country reports. And finally, we will be looking at the filing mechanisms used and the government-to-government exchange mechanisms that will be relevant. And of course, such a government-to-government exchange mechanism will be specifically important for the country-by-country report. We expect to finalize our work on this in the coming weeks. We will provide it to the CFA for approval in January, and then we expect to publish guidance on this in February 2015.
Thank you, Marlies. And you can all see that the follow-up of the 2014 actions is quite important, quite demanding, and we know very critical for you all. That's why, as early as February, we will provide detailed guidance, in particular on the country-by-country reporting implementation package. We will also have seen that there was some news on the ruling issue and the need for transparency. We're extremely glad that the European Union has decided to move along quite quickly, implementing the decision which was presented to the G20 for more transparency, which means spontaneous, compulsory exchange of information of tax ruling, which is equivalent to automatic exchange of tax rulings. And finally, on patent boxes, we're glad with the progress made, and by the end of the CFA, and maybe earlier, which is at the end of January, we'll have, we hope, consensus on this approach and being able to provide all the guidance for the businesses to anticipate the implementation. But let's now look forward to 2015, going into the details of the discussion drafts which have been published, and then those which will soon be published. So these are the discussion drafts, and we'll start with Marlies and the artificial avoidance of permanent establishment and Action 7.
Yes, and thank you, Pascal. Oh, sorry. Thank you, Pascal, for that. And for those who have been following this work, a discussion draft was released on October 31st. And that discussion draft includes specific proposals for the Model Tax Convention update in this respect. There are a couple of things that are important to recognize. The first is that we've been looking at insurance issues and reinsurance issues, but also realize that there is an important interaction there with Actions 4 and 9, and also recognize that this may be better taken care of in those action items. The second thing that is important to recognize is that this action item also looks at profit attribution to PEs. And there we concluded that there are no very important substantial changes needed, although we did recognize that there needs to be some clarification on this issue. In the discussion draft, a deadline is given for the 9th of January 2015, so we hope to receive your comments before then, and then we will have a public consultation on this on the 21st of January 2015, and that will be back-to-back with a public consultation on treaty abuse that I introduced earlier. And with that, I would like to give you a bit of a flavor of what's in this PE discussion draft. As you know, Action 7 asks for the following, and the first is that we need to develop changes to the definition of the PE to prevent the artificial avoidance of the PE status in relation to BEPS. And that includes the use of commissionnaire arrangements, it includes the specific activities exemptions, and as I said before, we were also asked to look at profit attribution issues, and there we concluded that no substantial changes are needed. On the commissionnaire arrangements, it is important to recognize that we're talking about arrangements through which a person sells products in a given state in its own name, but on behalf of a foreign enterprise, and that foreign enterprise is the owner of these products. And as a consequence, this person that sells these products in its own name only gets the remuneration, the pay for the activity it performs itself, and there is no profit attributed for the profits for the products that are sold in the country. And that can lead to a lot of artificial shifting of profits, especially if it's done intra-group. So for that reason, 4 alternative options have been presented, that will recognize a PE where an intermediary sells goods that in a country based on the regular conclusion of contracts on behalf of a foreign enterprise. So in those situations, we will no longer look at the pure legal question that is being looked at now, but more look at the actual transactions and the actual conduct taking place. Companies acting exclusively for related parties will not be seen as independent enterprises in this and independent agents in this situation. So that also leads to less possibility to artificially shift profits intra-group. So that's in relation to the commissionnaire arrangements. And then the second issue we were asked to look at very specifically is the specific activity exemptions. Article 5.4 of the Model Tax Convention names a couple of specific activity exemptions. For example, when you're looking at delivery. And in the time that these provisions were drafted, the assumption was that these kind of activities that were being performed were auxiliary or preparatory, and therefore no profits or hardly any profits would be attributed to these activities. And that's why a per se exemption was being concluded at that time. However, in the current time, the question is whether that's still valid. And therefore, there are a couple of options that are recognized to deal with these exemptions. The first is to make the exemptions conditional on actually being preparatory and auxiliary. The only opposition that we received and the only criticism that we received in this respect is that this may lead to a very subjective norm and therefore will not provide a lot of clarity. That's why we also provided a couple of other options that are more specific. For example, by striking out delivery, striking out purchasing offices, or striking out purchasing offices and places maintained for the collection of information. So that is what we are going to do in relation to the specific activity exemptions. There will also be new anti-fragmentation rules. As you see, it's very important that we look at the M&E group as a whole. And the anti-fragmentation rules that were in the current Model Tax Convention only looked per entity and not at the group as a whole. The current proposal does look at the group as a whole and therefore looks at fragmentation of activities that are complementary functions that are part of a cohesive business operation. And if that is a case, it will no longer be possible to fragment your operations to prevent a PE. There's also a new rule for the splitting up of contracts in construction situations, and I refer to the draft if you want to look at that. So as said, deadline for comments is the 9th of January, and I look forward to seeing you at the public consultation on the 21st of January on this issue.
I think it's over to me now, and we're talking about interest deductibility. Maybe a recap before we get into this area. It's a complicated, at the same time, I think a very important area. So this is just a recap of what the action item actually says. It talks about developing recommendations regarding best practice and the design of rules to prevent base erosion through the use of interest expense, related party and third-party debt. I think that's important as it's brought out. Talking about excessive interest deductions here to finance the production of exempt or deferred income, and also other financial departments that are economically equivalent to interest. The last bit of the action item then makes the important link to our transfer pricing work, which is not covered in the discussion draft that is coming out yet, but will follow in the new year. So maybe then to say it up front, the paper, you'll see that on the last slide, but I may as well say it now. The paper is coming out still this week, towards the end of the week, so it is in time for Christmas. If you didn't know what to do over Christmas, we have a very long report for you. It's not that long, it's detailed, it's an important area. And so it will be coming out towards the end of this week. So I'm in a slightly different position from Marlies because the paper isn't out yet, so I can talk about what you haven't seen, which makes it easier and more difficult. Apart from the connection to transfer pricing, I should also mention that we're fully conscious and aware of the connections to other work streams of the BEPS work, be it the hybrids piece, and it may depend about the particular type of interest expense rule that we bring in that may have an impact on how it interacts with the hybrid piece. We're also aware that it links to the CFC piece, and we're fully aware that it will certainly reduce the amount of interest income that does go into a low-function CFC, but those are important implications that we are looking at as we move forward on this item. What do we look at? We look at a number of questions. I'm going to jump to the next slide if Pascal presses the button. Yes, I'm jumping to the next slide. So in some sense, what you see here is the main two approaches that we are exploring in the discussion draft. It is not the only questions that we're exploring. We have a whole series of questions on which we are seeking input. They range from questions on whether rules should be net to gross, who they should apply to, what the definition should be of interest and equivalent payments. There's a whole series of questions, also including whether we should have a carve-out for small entities, thresholds, amounts. There's a whole series of questions where we go through, and some of those, and that's why we've taken them out, some of the probably key design questions do go to the question of whether you may want to have group-wide tests or fixed ratio tests. And then importantly also the question, could there be some combination between the two, and if so, what? Now, if we start with the group-wide tests, what do they do? That will not surprise you. The idea of a group-wide test is that it limits the company's net, and that's important, interest deductions to a proportion of the group's actual net third-party interest expense, and that allocation would be based on a measure, and there's different measures in the paper, of economic activity, such as, for instance, earnings or asset value. The idea here is that you balance two considerations. One, you give companies the deduction equal to the real cost of funds, so what's actually paid to third parties, while at the same time the idea is that you protect countries from excessive deductions in their country. The idea then is that we have groups that continue to centralize the third-party borrowing in some centralized entity that might have, and that may be for non-tax reasons. But it's still efficient and it still works while providing the tax relief for an interest is matched with economic activities and their different measures, as I said, in the first principle. Important also here, there's different variations, and we explore those in the paper, of how this could be done. Could be done on a range, if you wish, from a completely consistent approach where all the relevant factors are agreed and implemented consistently in all countries, to something where there is more flexibility and only some of those factors would be standardized, leaving more rooms for countries to build on existing approaches that they have. Important here, we recognize that as a primary rule, as a main rule, currently this is not operated by countries, but we do see those as particular carve-outs in existing company rules. So let me then move to the fixed ratio test, which is the other option that we are exploring. That operates by applying a fixed benchmark ratio to an entity's earnings or asset values. Again, it is probably a more straightforward approach for groups and tax authorities if we think about it in today's environment, because many countries have variations of this approach. It is, on the other hand, somewhat more inflexible, as it applies the same benchmark ratio to all entities of different sectors and irrespective of their third-party gearing. It's therefore difficult sometimes to establish, and we should say, quote-unquote, the correct benchmark ratio. And when we started to look at some data, which is on the next slide, you also see that that's brought out, that sometimes when you look at the actual third-party gearing of companies, you may not find those closely linked to the sorts of ratios we see in countries' rules that are currently out there. So if I throw up the next slide, what that shows you is we've gone through some publicly available data. This is the global top 100 companies by market capitalization. We've taken out the financial services company in order to have just the non-financial sector companies. And here you see some indications. You see where is, looking at the third-party interest expense relative to EBITDA, where do they stand? And you see that almost all of them are below 20%, below 10, below 5, and some, in fact, if you look at the net basis, and we're looking at net here, then they have net interest income. We fully recognize that we only looked at a sample. We know that those are large companies. We're going to continue to do work also on smaller companies. That's important. We know that there's difference between taxable profits and accounting profits, and we're going to work on those. But we just wanted to give you a flavor of some of the data, and you find all of this, of course, also in the report itself. So then, if we look at not just those approaches in isolation, but we also look at some of those approaches combined, where does the paper take us? Well, it shows us possibilities of combinations. And again, we're seeking input not just on those standalone approaches, on perhaps some other approaches that are also discussed in the paper, but also on possible combinations of these approaches. One approach could be have a main rule that is a group-wide test. And as I said, that's a range. So there's different things how you can construct a group-wide test. With a carve-out, there's a fixed ratio. So you can, if you wish, as a safe harbor, you can opt in there. Another approach, not that different, is to combine them in the reverse order. So your main rule would be a fixed ratio test. And then there's a carve-out that allows you to get higher interest expense if that is what you have in your third-party gearing, possibly at the expense of having higher compliance cost in that. So there's a balance between the interest approach that we use and perhaps the simplicity of the approach, but always with the idea that we make sure that where there is interest expense incurred, that interest expense remains deductible, that we seek to avoid double taxation, but at the same time that we're trying to make it somewhat simple and also work on what's out there in fixed ratios. So that, I think, is probably in a snapshot where we end. Importantly, the paper, you don't have it yet. It is coming out this week. We will be asking for comments by February 6th. There is a public consultation meeting for the February 17th. All the information about how to register is in the press release and then also in the consultation document. And please, and this is important not just for this item, but for all items, this is a genuine consultation document. We will need your input on all of this and very much looking forward to discussing it with you in time for the consultation meeting. Thank you. And I give it back to Marlies.
Thank you very much, Achim. And compared to what you just told us, I think this is going to be a piece of cake, actually. So low value adding services, and this is all about simplification and transparency. And again, on this one, a discussion draft was released on the 3rd of November 2014, and comments are being requested by the 14th of January. So what are we doing here? We are proposing a simplified approach in relation to management fees and head office expenses, because each multinational group has these centralized services that are being provided, and they are a source of controversies, both for tax administrations but also for businesses. And that is mainly due to the fact that tax administrations have very limited means to check whether the service fees that are being charged to them are correct. And because of that, sometimes businesses complain that real business costs are not being deductible anywhere because tax administrations are too firm and are not letting them deduct it. So for that reason, we came up with a simplified approach that is more or less pooling the costs in a very transparent way, using very transparent and good allocation keys to distribute the costs, but do it in a way that is transparent for all tax administrations so that they know they are treated equal to other countries and that they don't get a bigger share of the costs than they ought to get. This will lead to limiting possibilities of profit shifting through excessive service charges. It will also lead to transparency and therefore more trust in the system. And it will lead to simplification because there will be a more uniform approach by all countries in relation to low value adding services. So on this one, not brain surgery, it's not a very complicated thing, but it is a very important thing for both business and tax administrations. And that leaves us to the multilateral instrument, Action 15.
Talking about brain, not surgery, just brain. So for the multilateral instrument, we issued a report in September 2014 that concluded that this was feasible and desirable. And what we are doing at the moment is to develop the text of the draft mandate for the group that will be tasked to draft the content of the multilateral instrument. And this mandate will deal with issues like the scope of the instrument, namely the modification of bilateral tax treaties to introduce the measures that have been developed in the context of the BEPS project and require a treaty modification, and also the timeline, with the expectation that because the substantial work will be carried out in the context of the BEPS project and be finalized by 2015, the timeline for the multilateral instrument will be relatively short. The CFA will discuss the mandate at its January meeting, January 2015, and once approved by the Committee on Fiscal Affairs, the mandate will be sent to the OECD Council and to the G20 with the view to convene this ad hoc group of parties that are interested in streamlining their treaty amendment process to introduce these measures to start the work as soon as possible. If then I move on in the interest of time regarding what's coming up next, and when we say coming up next, we actually mean this week, so before the holiday season, for those that will be taking holidays, we will be publishing, as Achim has mentioned, the discussion draft on interest deduction and other financial payments, the transfer pricing discussion draft on risk and recharacterization, a discussion draft on the transfer pricing aspects of commodity transactions, an issue that is very dear to a number of developing countries, and in the context of the transfer pricing action items, which I remind you are 8, 9, and 10 of the BEPS project, how profit split methods can be applied in the context of global value chains. Finally, there will be the discussion draft on dispute resolution under Action 14 of the BEPS project, and as I said, some of these may well be published tomorrow at the latest, assuming there is approval from the Committee on Fiscal Affairs. They will be published by the end of this week, so that there will be quite some reading for the holiday season.
Thank you, and thanks to the team for this update to you all. You can see that we still are working very hard on the follow-up of the 2014 with a real focus on the implementability of what we're doing for both tax administrations and for businesses, to make sure that it's cost efficient and that it's useful to all, that we're working hard involving developing countries in this project so that their views be reflected on the implementation of 2014 deliverables and on the 2015 work which is going on, and that we are consulting you, the business community, the NGOs, all the stakeholders on the different papers which are going out soon, which have been out for a few weeks, so that you can input usefully. And we will get back to you as we committed earlier. I think we committed to this in September. We will give you feedback on the comments received. So not only shall we include the comments in the papers when we revise them, but we will also get back to you on what we've done with your comments. I hope this has been informative. We have some time to respond to some of your questions, and a number of questions have come in while we were making this presentation. I would just like to highlight that we'll get back to you soon because there is a lot of material with all these papers out. I think there will be enough room for another webcast, probably in the early February 2015, so in a bit less than 2 months' time, we'll be able to get back to you to brief you. But for the time being, I'll turn to Larry, who will raise a number of questions that you've sent us.
Thanks very much, Pascal, and thanks to all of you for running us through all of the forthcoming deliverables, the second half of the BEPS project going forward. Just to remind all of you watching us online, participating here, please do participate now. Enter your comments, questions, send us by email, tweet. I'm going to jump right into the questions that we've received. To start with, going right to something that's very topical in the news, of course, considering the recent developments triggered by the 2 Luxembourg leaks, will the OECD consider recommending compulsory, spontaneous, or automatic exchange of all rulings rather than rulings related to preferential regimes only? I think we'll direct that question to Achim.
I think we actually have a relatively broad understanding of the term preferential regime. So we're not just talking about legislative regimes, the ones you easily find on the books, but also those created by administrative practice. I think that has always been part of the work on FH2P and will continue to do so. We see the relevance of that. We're moving forward on that. So do understand that very broadly.
Thanks. Pascal, please.
Yeah, just to I would just like to add a couple of points on this one. First, we've received a tweet, so thanks for the tweet, Ferskat, saying that compulsory spontaneous is not automatic, that it's not true. Well, please let us know why it wouldn't be true, because that's our common understanding with the European Union and us. When you're obliged to exchange the information spontaneously, it's actually equivalent to automatic exchange of information. That's the same goal. We can call it the way we want. So if you're more comfortable with automatic, let's call it automatic. But the end result is exactly the same. So it's true. The second comment, just to draw on what Arim has said, it's true that the work on harmful tax practices relies on the criteria which were developed in the mid-90s. That said, there is agreement also within the Committee on Fiscal Affairs in its BEPS component, meaning all the G20 countries on equal footing, and now with the developing countries joining, that all the rulings which are likely to be detrimental to the tax base of another country should be exchanged. And this should not be limited to preferential regimes types of rulings. I was in Luxembourg a few days ago meeting the Prime Minister and the Minister of Finance, who had been on the hotspot, as you know, and they were crystal clear on this interpretation of what will be done. So I think we can be confident that's the way we're heading to, and together with the European Union. So I think here we have a very strong approach which will be implemented, which will be monitored in the context of the harmful tax practice forum, as well as within the European Union. So very strong stance in this area.
Thanks, Pascal. Considering the high level of interest in country-by-country reporting, we'll have a question on that topic. Considering that there was an elaborate assessment by the European Commission concluding that public country-by-country reporting by the banks is desirable, would not have negative effects, could the OECD consider also carrying out an assessment of public country-by-country reporting in other sectors? Could you consider postponing the CFA decision on means of dissemination under Action 13 until such an assessment has been concluded? Marlies, it's you.
Yes, thank you very much, Larry. And to also say something about rulings, since we're on transfer pricing documentation, I think it's very relevant to also indicate that both in the global master file and in the local file, rulings that relate to the tax base in a certain country relating to transfer pricing need to be indicated in both of the files. So that means that not only on the government side there needs to be transparency about the rulings concluded, but also on the company side there needs to be transparency on the rulings that have been concluded that relate to a certain country. So I think that is very relevant to also notice. A second thing that I would like to say in relation to the question is that the starting point is that we have been asked to look at government-to-government exchange of the country-by-country reports. And what I also would like to notice is that as we have experienced last week when we were talking to developing countries, there is a huge interest in receiving these country-by-country reports and receiving them very, very quickly. So that is what we're working on, and I don't think that there is any reason to stop working on that. And I think we should continue to make sure that these reports become accessible to as broad a group of countries as possible. And that is also something that definitely is the intention of this action item. The intention is to make it available to all governments that need it and that want to commit to the considerations that we have just mentioned, consistency, confidentiality, the use of the information. So governments should be able to use the information regardless of whether it's public or not, because they will be able to get the information.
Thanks very much, Marlies. Another question that we've actually had several from those of you out there watching about an issue also very much in the news, which is the UK's proposed diverted profits tax initiative. Quite simply, do we see that as being compatible with the BEPS action plan and our recommendations? Pascal?
Thank you, Larry. We are still looking at the 18 pages of draft legislation which have been issued late last week. I think the UK initiative of diverted profit tax is extremely interesting as it shows the relevance of the BEPS action plan. It shows that there is a highly political concern about tax avoidance, and it shows that governments are not shy taking action unilaterally. What we wish, of course, and that's the other philosophy of the BEPS action plan, is that these be addressed through multilateral action. So we hope that the UK move, which again shows a very strong political stake in these international tax topics, will be compatible with the development of Action 1 of the report on the digital economy, of the solutions which will be provided, so that at the end of the day we have a coordinated approach which is not detrimental to investment, which is not detrimental to government revenues.
Thank you, Pascal. I think this is a question probably for Rafa. Do you intend to implement Action 6 through the multilateral instrument? And if so, how do you account for the need for bilateral adjustments recognized in the discussion draft?
Thank you. Very good question. Yes, absolutely. The work on Action 6 is certainly a candidate for the multilateral instrument. As I said before, together with the other outputs in the context of the project that will result in changes to the Model Tax Convention and therefore to bilateral tax treaties. As it was already recognized in the September report, there is a need to ensure consistency around core provisions, but at the same time to provide flexibility so that countries can bilaterally reflect in these provisions their economic relations. So that's certainly something that we will be doing, and that relates both to the LOB provision and to the principal purpose test.
Without going to Larry, I will respond live to a tweet we've just received on the rulings. We're having a debate on the rulings. So just to make sure we are clear, spontaneous but compulsory exchange of information is likely to be in the hand of the country obliged to exchange the information. So it's all about the ability to monitor whether this information is properly exchanged. As Marlies said, it's not one action in isolation. You need to look at it with the light of the Action 12, which is about mandatory disclosure, but also in light of Action 13, which is about the transfer pricing documentation and the obligation on companies to disclose the ruling, the benefits. So countries will have a mechanism here to monitor whether their partners properly exchange the information. So it's not left in the hand of one country without any control. Second, the problem is, what about exchanging all rulings? And that was one element of the written question. The fear we would have here is that with too much information, you kill the information. We need to be very mindful of not flooding tax administrations with millions of data which will not be useful to them. And that's why exchanging all rulings without any form of limitation might sound pretty interesting at first sight, but it's probably the wrong solution, because then, I mean, if you don't want somebody to understand your business, provide all the information like this, and for sure, this person will not be able to do risk assessment or to target the information which is actually needed. That's why there will be discussion there, and we can trust our governments, the G20, OECD governments, to make sure that the relevant information comes to them.
Thanks, Pascal. Marlies, another question for you on country-by-country reporting, no surprise. Can we expect a de minimis threshold for country-by-country reporting in the follow-up to the work on the 2014 deliverables?
Thank you, Larry. Yes, and as I said when I introduced it, one of the questions we are going to address is which multinational groups will need to provide the country-by-country report. And there we are definitely looking at a small and medium-sized enterprise exclusion, but the decision on that needs to be taken by the CFA. So it's not decided yet at this stage.
Great, thank you. One more follow-up. Some of our people observing out there are also wondering, in the same way, the follow-up on the digital economy. Maybe I turn that over to Rafa. Will there be a further discussion draft, further in-depth communication, any discussion of the work of the Working Party? Where do things go on the digital economy, or is it simply a let's wait until the end of 2015 to see how this all flows out? Maybe Rafa, go ahead.
Thank you, Larry, and thank you for the question. The task force on the digital economy is going to meet in early February and decide on these issues, whether to publish a request for input on some of the specific points that were highlighted in the September report, whether to issue a fully fledged discussion draft, or whether to wait for the advancement of the remaining work in relation to BEPS, and after that we will definitely advise. Having said that, if there are spontaneous contributions that stakeholders would like to make in light of what went public in September 2014 on the digital economy, that will be always welcome. Thank you.
Thanks very much, Rafa. I have time for one maybe final question here. A few different folks out there have asked us something that you addressed very briefly at the beginning, Pascal, which is the role of the developing countries as observers and participants in the BEPS project. People are wondering, what role will they play? And maybe you could just give us a little more detail on that, where you see that going forward in 2015.
Thank you, Larry. That's a big change. I mean, 2 years ago, the OECD Committee on Fiscal Affairs was 34 member countries, all the OECD member countries, plus some observers. We now have 44 members, all the OECD countries, plus the 8 G20 non-OECD countries, plus Colombia and Latvia, which are in accession process to the OECD. We're now adding another 12 to 14 developing countries, which will be joining this project. As invitees, as participants, not as associates, meaning not legally on an equal footing, but the way consensus develops at the OECD on this project with the support of the G20, which is telling us, please make sure that the views of developing countries are reflected. This is actually a matter of practice for these countries to be on an equal footing and agree on consensus. So we're heading into that direction. The participation will be twofold. One, in the Committee on Fiscal Affairs and all the working parties. So it's not just about sitting in a place where things are largely digested when they arrive, but rather being in all the working parties. And we will pool some of their resource, because some countries might have an expert on transfer pricing, while some others might just have one expert on tax treaty. So we'll make sure that their views are reflected in all the working parties and in the Committee on Fiscal Affairs. We have invested there. We are recruiting 2 persons who will be full-time dedicated to help the developing countries making their point, so that their participation is not lip service paid to the international community, but real input by the developing countries. The second tier of their participation will be in the development of the toolkits that we will also be doing with the other international organizations, the IMF, the World Bank, the UN, but also the regional tax organizations like CIAT, ATAF, and some others. So their participation will be on the standard setting mechanism on the one hand, and possibly identifying other actions to develop, and they will also be participating in translating these standards into practical tools for tax administrations, so that they are equipped there to address base erosion and profit shifting, to also address the elimination of double taxation, while their overall concerns on the balance between source and residence will also be discussed. So quite a holistic approach at a time which is critical. We have 1 year to go in the BEPS project, but this will set up the scene for the post-BEPS environment, which will come. It looks very far away given the amount of work we need to do by then, but after all, this will be in 1 year time.
Pascal, thanks very much. All of you members of the CTP team, thank to all of you for joining us today for this BEPS webcast. We will continue reporting to you next year as the project goes forward. Continue to visit the OECD website for further information on all of these on all of these elements moving forward. Please participate in the discussion and public comment periods. And I wish you a very nice day. Thank you.